Hello, hello, hello. Happy Wealth
All right.
Webinar. Wonderful Wednesday. Here we are with another Ask Me Anything happy hour. I don't know if we're all drinking, but this is the crew today, I believe. I don't know if we'll have any other surprise hop-ins. Maybe a Hannah, maybe somebody else will pop in. But
I was thinking Chris and Joe are driving, or they will be soon. So they might pop in on their drive. Actually, I think they're done. They might be driving now. So they might pop in, but probably not. It might be focused on other things. So yeah, you're stuck with us today. I do have the fun intro, and I think I know how to do it without screwing it up. So just to get everybody pumped, here you go.
Good.
love it.
Good job, Gabby.
Thanks.
Good work.
It's really
Good
not
afternoon,
so
guys.
bad.
Let's go around the room and share a fun fact about each of us. Let's have some fun. Let's start off. So, America's youngest money mentor. You seem like you're ready with a fun fact about you. Let me know about you.
Let me kick it off. I was thinking about this today actually because this morning. So I'm not a mountain biker. I'm not a very good in the wilderness, I could say. I'm a sporty person. I love sports, but I'm not mountain biking material. And so last night I was hanging out with some friends, and a guy invited me to go this morning with him mountain biking, and I haven't gone in years. So I was like, sure, good opportunity for me to go and get comfortable with it, confident in it again. It's been a long time, and just have fun. So I went this morning, and we get to this hill, we're about to go down. I look at this place, and he just starts flying down, fat jump, does like 2 more jumps and keeps going. And I'm like, no way I'm following that, And so I just like slowly went down the hill, my first time in a while. And I literally biffed it going down, thinking I was going to like go a little fast, but I fell. I got back up. I kept going. I was starting to get a little nervous and watching him go so fast. And then I went again, and I fell again. I got back up, and I kept going. And I eventually got comfortable and confident, and the rest of the ride was awesome. But I'm coming to the point here. I was thinking about it the rest of the ride, like, wow, that kind of sucked. And I was pretty nervous and trying to figure it out. And then once I got comfortable and kind of pushed myself to keep going, I got it, and I was crushing it. And so it kind of made me contemplate infinite banking and some of the clients we have, and just life in general. It's just, we get hung up on little things sometimes, and we get stuck when we're trying to accomplish our goals, but we can continue to keep pushing, keep going, and we'll eventually get there and have a lot of fun while doing it. So that's my little message for you guys today, but doing good, ready to talk to you guys.
Hero, brother. That's an amazing story. And way to wrap it up with a, very poignant point for all of us. It's like, imagine if we all decide as babies, hey, this walking stuff is hard. I ain't going to do this.
Yeah.
Crawling around imagine what fashion would look like then, driving, all the things. It'd be weird, right? What a weird world if we just crawled around. We decided walking's too hard. So how about you, Mr. Yenny? We had a good hour-long conversation. What's a fun fact about you other than you're not going to play the guitars for us yet? So
yeah, someday I'm going to actually learn how to play those guitars. We'll see. They're just wall decorations. I think I may have shared this before, but it is kind of a fun fact I like to pull out every once in a while. I don't know if you guys remember this, but remember the Kool-Aid Man?
Yes, sir.
Mm-hmm.
Yes. I grew up on the very street where Kool-Aid was invented in Hastings, Nebraska.
That is
that's pretty cool, huh?
Did he run through the wall when he invented it?
I don't know if the Kool-Aid Man ran through the walls, but he came later. But the actual Kool-Aid itself was invented on the same street that I grew up on. But if you ever travel through Hastings, Nebraska, and you go to the museum, they have an entire section about Kool-Aid.
That's so funny.
How about you, Miss Gabby? What's your fun fact for the day?
Well, for anybody who likes and follows football, this is a fun one. My husband and I once won a dinner with Thurman Thomas and his wife. So here in Buffalo, we met them out. We had dinner with Thurman Thomas and his wife, and it just kind of made me realize that, people are just people, no matter what they are, how whatever level they're on. He just literally walked into this really fancy restaurant with not really fancy at all. And I was like, okay, he's walking around like his shit don't stink, but we all know everybody is on the same level. So it was cool to see, to kind of see, because he was one of my dad's favorites. So he got we got signatures and stuff, but we had a good time. But it was cool to just see people are just people. You know, nobody's really above anybody else. We're all just the same.
I love that. We got some depth in our conversation here today already. We got some life stories like, hey, just keep getting up and have fun while you're doing it. Don't be afraid to fail forward. Hey, people are just people. And then Mr. Yenny's giving us some history facts. If we want to go to Hastings, Nebraska, we can check out where Kool-Aid ran through the wall and was invented.
Well,
so
I guess I failed to put some meaning behind this. So when people tell you, here's the thing, when people tell you that infinite banking doesn't work, don't drink the Kool-Aid.
Oh, that's good. Nice wrap.
There it is.
there you go. Way to bring it full circle. Let's see. My fun fact. What haven't I shared about myself yet? How about we'll do this one? I once placed 5th place in the American Lindy Hop Championships in Strictly Lindy. With that's Lindy Hop swing dancing. So in
That's
Connecticut.
so funny.
So that was something that Carson said. Like I used to say, oh, you know what? I hate dancing by myself. I feel so awkward and stupid. But you know, if I can go dance with someone that's better looking me and show them off, that's a lot of fun. So that's the same thing. It's, you know, you fail forward a lot. You're really goofy when you first start it, but eventually, if you keep at it and you keep repetition, you do it over and over and over again, you can get pretty damn good, right? Even if you're someone where you go to classes now, like go to Taekwondo, and you know, my Brazilian instructor will be like, he's in 8th grade, and he'll like, oh look, you can tell where the little sipple gets his rhythm from, or lack of, right? I'm like, come on, man, I used to be a good dancer. That's not true at all. So that's my fun fact.
Funny.
So looks
That's
like we're getting
good.
some. Looks like we're getting some questions in our chat.
Yeah. We'll start with Leo. Love the name, by the way. My kids just all named our newest cat Leo, so I use that name every day. Leo says, how much do I need to get started with IBC?
Who wants to jump in on this one? Craig and I were just talking about this about an hour ago. So
Let's see
There you go.
Carson-
What'd you guys conclude? No, what'd you guys conclude? I'm curious.
I want to hear Carson first. You go, Carson. You leaned all the way in. So.
I mean, you don't need anything to start. I think you need an open mind, and I think you need to have some sort of savings every month. And if you can get that put down, I think we can make a conversation out of it and start something from there. But you don't necessarily need 10 grand to start, like some people say.
And that's funny because that's almost what I was going to say. Because I would say it's really, we all have to be in 2 businesses, right? The business of making money first. And then once you figure that out, it's like, how do you become in the business of banking to control your money? Because once you know how to make money, it's like, how do you keep your money and stop paying it to other people? So while Carson is absolutely right, if you're focused on making this work and you want to learn the process, you can do 10 times your age. I saw someone write that in the chat. But what I would say, like, if you're Carson, you're 23, or, you know, you're someone's 30 and you 10 times your age, that's $3,600 a year, you know, 300 times 12. And at the end of the day, you're going to have a portion of that available to borrow against in year 1 and year 2. And if you live in California, you live in Florida, you live in Colorado, I don't know what's like up in Buffalo, but that's going to buy you like a tank of gas and some eggs. So like the first question is really, what is the problem that you're solving for, or the opportunity in front of you? And once you know what those numbers are, then you can play a game. Craig does this for people. He's like, hey, I want you to pay yourself $800 or $833 a month for 3 months. And if you do that, come back to me and then we can start the process. But first you gotta love yourself first. And you gotta love
and I like what Matt said. I put up on the screen. He said, I think everyone will tell you that you'll wish you put more once you started. So and that's definitely the truth.
The question will change to, how much do I need to get started, to how much can I put in?
Yes. Yeah.
But you know, one of the things we think about, Leo, is and we kind of talked a little bit about this piece, but I'm going to add a little more to it. If you came to us and said, I've got $30,000 of debt that you want to use an infinite banking policy with to pay it off, and you're only going to put in $300 a month, it's not going to be real effective to, you know, make a lot of positive momentum on that type of a setup, you can still do it, but the more you can apply towards that debt, faster we can get it paid off, and the more we can get replenished back into the policy. If you're trying to do a real estate deal, it's always working back towards what you're trying to accomplish. Like Jason said, whatever you're trying to accomplish, then we can figure out, what the funding portion of that looks like.
Mm-hmm.
And if you don't know what it is, you don't have clarity, that's okay too. Tons of people, 1,000 conversations, tons of people don't have clarity. Ask yourself, what do I really want? Like just the open-ended questions. And why do I want it? Why is that important to me? Is it the pool that you want to build for your family so you can have more magic in your life? Is it to pay off the debt so you can feel like you have freedom and you have control and you're not paying someone else that money? Like, what is the thing that you're looking to accomplish? That's when we can really help you. If you know that, then we can come up with a plan. We'll even tell you ways to get money for free, right? Not for free necessarily, but ways that you don't have to invest something to create money. Like there's all different things in this ecosystem that you're going to learn on the journey. But the first question is, why are you doing this? If you can't answer that, then go back to the drawing board and come back to us when you can, because truth is you won't make it to the end if you don't know why, because you'll get just distracted. You'll do something else. You won't have enough skin in the game to do it. Right? Like I have a buddy who said, Jason, can I do an Ironman? I said, dude, you're one of the best in shape dudes I know. Like you can walk around on your hands at age 40 something. You can do any sport you want to. You play hockey. Right? Of course you could do an Ironman. He's like, well, I'm not a very good swimmer. He's like, that's okay. We'll figure that out. Well, I don't own a bike. Well, you should probably get one. And then the next thing was like, well, did you put skin in the game? Well, now he's paid $850 to race. And now he's dropped, $3,000 on a bike, and he starts, I'm like, now you need biking shoes. You need a helmet. You should have a helmet on. Like Carson, I hope you had a helmet when you were crashing this morning.
Did.
Right. But like you need to have skin in the game to put your focus on it. Because otherwise it's just going to be like over there. And for this to work, it has to be right in front of you.
Mm-hmm.
That's great. I'm going to go back to Alan, your questions next, but I just wanted to touch this one really fast. So Scott, so you can get your questions out. He said, can we ask questions about starting a business? Definitely you can ask questions about, anything related, anything you have questions on within reason. And we can't promise we'll answer them or can answer them, but yeah, definitely put the questions out there. And if I can't answer them, then we'll try to direct you to somebody who can. Okay, Alan's got a good question. He said, can you do a dump-in in the middle of your first year, or does that need to happen when you start your policy?
Who wants to take this one?
This is a good question.
I feel like Craig knows this one.
Yeah, you want to do it, Craig?
All right, I'll take it. The answer is yes. There is a risk with the approach, though. Here's what happens is when we design policies with a dump-in, there is a possibility that if you don't do it right away and you do it later in the year, you may not be able to get the full amount that you wanted in. And it just has to do with the MEC rules. So that's the risk. It doesn't mean it will happen, but it can happen. But you can dump that in later in the year.
Yeah, and that was something I learned, Craig. I love that I told someone who was receiving I forget what it was, but he was getting a settlement or something where he's going to get like $60,000 3 months after he funded the policy with a monthly. And we designed it, like you said, to dump in that money later. But then the company came back and was like, you know what? That might MEC when he puts that amount in. You just have to ask, because that's always a moving target, because your cash is increasing every day. Your death benefit's increasing as well. So that number is a moving number. And we were talking about this earlier, Craig. You can't MEC a policy without writing permission, right? Like that's one of the things with the companies we work with, that you have different kind of safety measures in place. So,
yep.
And maybe you can explain this deeper, Craig, on why this happened. But I have an experience with the client about a month ago where this guy was about to fund his policy. He had a dump in, but then he came back to me, similar situation, and said, hey, I can't do the dump in for another 4 months, but I want to start the policy. And so we're like, okay, great. We'll start doing the monthlies. We'll prep the policy so that you can do the dump in later. He was awesome, on board with it. Then we looked at the new illustration, and we had to add another $500 of term every year to up the MEC limit to allow for this dumping to happen later. And so then he's like, well, now I kind of don't want to do that because I'm adding an expense. I'm just going to wait a little bit and fund it later. So I'm not sure if that happens to every company. It sounds like Lafayette Life is a little bit better than One America when it comes to that. But maybe there's some clarity on that too, if you thought about it.
Yeah, I would have to see the policy, and was that dump-in removed from the policy when it issued? Because that would be one concern. But the reason term needs to get added when there is a dump-in is that we have to make sure the amount of money going in matches the amount of death benefit, not matches, but is in the guidelines of what the IRS needs for it to be, prevented from being a MEC. So when they did that dump-in, they probably increased that gap between the premium and the amount of death benefit. That's why the term was needed.
Well, the policy was designed originally to not need the term, but then when we just changed it where we needed to fund the dump-in later that year, we had to add term. So that's kind of the question.
Yeah, and I think that's what Jason was talking about as well, as the policy goes on and cash value grows, that equation changes a little bit. So in that case, that's probably what happened. And that's why, when we answer those types of questions, it's, yes, you can put the money in later, but you may not be able to get the full amount in unless you do something like add more term or allow the room for it.
Yeah.
And this is why it's specially designed whole life for you, right? Based around what you want, because you hear the complexity in this, right? When you ask people like, what's the MEC? Where does it, how does it change? How does it change when I do the dump in? It all depends. It all depends on the situation. Had the conversation today, same one we're having right here with someone else, where it was like, oh, well, if he wants to make sure he can put in more PUAs, like unscheduled PUAs during the year, we have to add more term somewhere. So you can raise a MEC limit. And that's going to change every year. Like you don't know what it is in year 2, 3, 4, and 5 until you get to that point and you ask the company, like, what is the limit in year 2? Right? Even though you have your 7 payroll, you don't know the exact number until you're in that spot. So,
and there's some design considerations. You may just put a little extra term in there to allocate enough room if you want to do this in month 4 or 5 or 6. And that's going to add some additional costs. But at the end of the day, if you're trying to get that much money in to do a job, then that's what you've got to do. So
yeah, what is the job you want it to do, right? That's what goes back to that earlier. Yeah,
so you could perhaps just juice it up with a little more term than you need just to make that room for it. But it all comes down to ultimately what we want to try to accomplish with that.
Next question's from Brendan. This question I currently foresee a 2-part answer. The real answer, like just the straightforward answer, and then the real answer, the real answer. So what's the current interest rate on policies? He just signed his policy yesterday.
Well, congratulations, first of all. That's amazing. Welcome to now you're going from being a theorist to almost being a practitioner. So as soon as that's enforced and you start practicing moving your money, you can say you're a banker. You've got the Lubby or Brendan or what BL bank in effect.
Well, who wants to throw the numbers out?
I would just ask him, what's the company? Like, what company is it with? And we could give you a better idea. Right now, I tell people it's between 2 and 3.25%. Just depends on the company that it's with, right?
And I don't know, are they asking about the guaranteed growth rate? Brendan, are you asking about the loan rate? Or are you asking about the growth rate? So which
dividend?
Maybe you could just follow up with which interest rate you're after.
I think that means One America. One America. Okay. He said One America.
Amazing.
One America, and are you after the loan interest rate or the guarantee? So One America's guarantee on the contract is 3.25 on the guaranteed growth. And then their loan interest rate is what, 5.24?
I think it's 5.2, I think.
I think this might be a second part question. He said, I heard Chris talking about if you filed your policy by 2021, you would get a 4% interest rate, I think, on the dividend and growth, but I'm not sure.
I was listening to that presentation today, and I was thinking about this exact thing, right? That when we talk about numbers and they're dated numbers, they're gonna change. So like the process of banking doesn't ever change.
That's
Like
the real answer.
what we teach, right, doesn't ever change. So even if it's so the numbers, Brendan, for you, like I exactly had this conversation in my own head this morning on the way back from dropping my son off at school. I was thinking, okay, Chris is talking about a 4% guarantee. He's talking about he's the banker Chris. It's a 6% loan that he's giving out. But would you believe me that you're still making money at the end of the day at 4% compounded if I keep your money versus the 6% that you're paying me on that loan? Most people are saying, no, it's a -2, right? But then you got to really know what your money's doing. So Brendan, like the good news for you, your guarantee is 3.25. The loan's 5.2. You're actually in that same inverted scenario, but a little bit better than a 4 and 6. So your money is actually compounding more than the example than it's given in your loan to that. And then One America, the cherry on top of that is this isn't guaranteed, but they haven't missed a dividend in 124 years in running. So not a bad track record. So.
He said in this policy they stayed at a 1.25% interest rate, but I don't know exactly what that was for. I'm not sure either. Does anybody know? I would have to see it to know what that.
There's another place for you to look. It's in your. I can look in my phone. And Craig, I don't know if you know exactly where it is, but it's in your table of guaranteed rates, something like that. So hold on a second, I'll find it.
Yeah, that's in the contract typically, the guarantee.
Mm-hmm. Yeah, it's in your table of guaranteed values is where you want to look for your guaranteed 3.25% contractually. So that's where you can find that. So I'm not sure what the 1.25% is, but it is higher than that guaranteed.
Yeah.
And the actual law behind cash value life insurance states they have to be at least 2% anyway. So 2% or higher.
Look at that. I didn't know there was a law. I learned something every day from you guys.
7702. Yeah. So that's what changed in 2021 is the guarantees went from 4% to 2%.
Okay. Jeremy says, can I raise the premium amounts after I get started?
Jeremy, I'm actually texting back and forth with Jeremy right now, so it's good to see you. He's a recovering comedian, I think is how he introduced himself to me. So congratulations, Jeremy, getting approved. That's amazing. And the answer is, I mean, you got approved. We can go back with a higher premium if that's what you want to do. Like that's what we're texting back and forth about right now. Once it's approved, once it's set in stone and funded, that does not get the raise. Like we are building it around where you were at financially today. Eventually, when you're trying to pour 16 ounces of water back into a 12-ounce container, that is the catalyst for policy number 2. So your Jeremy, Jerdog, Danley, bank number 2, when that number gets big enough, that's when you want to have a second place to warehouse your money. I don't know if anybody else has a thought on that, but that's,
That's good. Straightforward. Brendan had kind of another comment. I just wanted to say something about this when he said he was going through the 48 some odd pages of his policy yesterday, just reviewing some of the fine details. So he's just reviewing that. So I just want to because a lot of people do this. They try to overthink it, overcomplicate it. And I know Hannah, I hear Hannah's voice. She says, paralysis by analysis. So
really
make sure you understand it. You have a healthy understanding of it. But I would not recommend reading page for page for page for page. Just know that you do have that contract. That is more to state that they owe you something in the case of your graduation. And all you really have to do in there is pay the premiums to get that. So just know that a lot of it is just what they actually have to put in there. A lot of it's just definitions and complications. Don't overthink it. And don't let it paralyze you. A lot of people are okay with it, but I definitely wouldn't recommend anybody just reading through some 48 some odd pages of a policy before they start. That's not typical, just so you know.
I love that, Gabby. And that is the truth, right? Some people are going to read it all. And I say, if you're a reader, you want to read all the contracts. I bet you Chris has read every word forward and backwards, right? Because he liked reading.
Maybe in his first one, and then he probably just skipped through the rest.
Yes. And you know, what we'll do as your mentors is we'll point out highlights to look for, right? Like I've had senators from Georgia that manage $80 billion and that's a trial attorney ask me questions. And like, I figure their questions are going to be some of the best questions that are going to be asked, right? There's someone that's legally wise or someone's managing billions and billions of dollars. And so the questions they're asking, like, where can I find the guaranteed rate? Where is this at? Right? Those type of things, we'll point those out to you so you know where to look. Because again, it's about the process. You want to know that everything that we've talked about is as advertised, right? That's still that little fear monger that you have in your head. You're like, oh, I want to make sure. It seems like it's too good to be true. Like now there's a 150-page contract and you go, right? You don't want to move forward. But that is just the one thing that you have to step through to get to the goal that you want to get. Like you got like Carson this morning, he got back on the bike and he had the best time ever. He could have just laid there crying, dirty, crying, upset after the crash. Right?
That's hard to picture.
He got back on the bike. So, you know, watch those, like Gabby said, watch that 150 pages, 148 pages. I mean, they're long contracts. They can be pretty intimidating. So we'll tell you what to look for.
Mm-hmm. Okay, Alex. Alex is having a child in July. Congratulations. Thinking of getting a policy started for him, like $6,000 a year. The goal is to be able to use it as it builds on debts until eventually it becomes educational savings. Is there anything that sets out a personal policy versus something in the name of the child?
Yes, there's a lot to this one. So who wants this first?
Is there anything that sets out a personal policy for someone?
So I don't know if Alex is asking if there's a different way we would perhaps design a child's policy versus an adult. You know, it kind of depends. Since they have so long for that policy to grow, we may not do as high of a split as we typically do on a 60-40. You might do a 50-50, but some of that might be considered. But it sounds like you're trying to use that for debt and then pay those debts off and then have that available for their first car, the college, whatever it might be. So it's possible we may design it differently, but some of it's going to depend on how quickly you want to use some of that for the debt payment too.
Mm-hmm. And with the children's policies, they're reverse engineered. So they're not engineered forward like we would for someone based on your net worth, based on your gross income, based on like putting insurance on your body, right? Your kid's body, it's based on the matriarch or the patriarch of the family, and then it's reverse engineered. So if you're looking to do $6,000 a month, we'd have to know how much death benefit you or your significant other has on their body. And then is that enough that we can reverse engineer it to get 6,000? Or maybe it's having another policy for you, if that's your outcome, that's going to give you enough juice to be able to do that, right? So there's a couple considerations, variables in how you'd want to design that, Alex. So great question, though.
And the only thing you need to start a policy for that child is once they get their social security number. So once they get that, you can start that process, however long it takes.
I was meeting with a guy last week, and he was setting up a policy on himself and his kids. And he looked at it, and I actually talked to Craig about this. He looked at it and he said, hey, my kids are structured to not have high cash value the first few years. It's a 60-40, but 60 base. And he's like, but 20 years down the line, it has a good amount of cash value, but it's still not as much as I was expecting for a long-term build of a policy. And so I looked at the numbers with him, and I showed him, I'm like, all right, man, you're 43. When your policy goes in, your premium goes in, year one, you have access to 83% of your money. When your child's going to be 43 your age, you're setting that child up for every dollar they put in, they were going to get $9.50 out. I was like, man, this is structured long-term, really, really benefiting your child. When he's your age, he's going to get 9 times the amount out, whereas you're only getting 80% of it out. Like that's the real kicker for it with kids. It's like you're setting them up to be a lot better than you are.
That's incredible. And that's the first principle, right? Think long-term. One bank's not going to do it, folks. It ain't taking back all control of all your banking needs for the rest of your life, but you can set up your kids. And every time you have a life-changing event, like Derek has a great point. Hello, Derek. Welcome every single week. Derek Kaufman's with us. You can't just put it on your favorite kid, right? You can't be like, hey, the middle child, yeah, they're definitely going to be the most successful. I'm going to set them up. But my youngest, my oldest, they're kind of dummies. Like, I'm not worried about them. It has to be equal across all your kids, right? Or pretty close to equal. Like, I've seen a little variation, but we're talking, cents, dollars and cents difference, right? But you have to structure it so you're insuring all your kids the same, because the life insurance company is looking at it as a risk. Like, why are they doing that? That's kind of weird. Like, they can't kill off the other two to get the, or kill off the one to get the death benefit on that one, or whatever it is, right? So it's morbid, funny, not, but, has to be equal. So
logical to the insurance company. Yeah. Does this make sense? Okay. Brendan says, if I can't afford the entire premium, can I pay it back in future months in addition to the monthly required amount? This is a good question.
It's a great question. The answer is yes, if you've paid the PUA little amount of money. So it's either $10 a month or $120 a year. You can just pay the base plus that and then be able to put in the PUAs afterwards, right? But you have to make sure that you're being very clear on what you want to happen again. So
yeah, that amount he's talking about, it's basically just renting the space, paying to rent the space, whether you use it or not. You're saying, I want to keep this open. I'm going to put this amount here to hold this space for myself in case I do want to put it back in later.
Again, how fun is this vehicle? How could you have so many choices? It's so much flexibility. There's so much abundance. You can change how you pay it on a yearly basis. You can change how you pay back the loan, right? It's unstructured. You can change how much you're going to pay. You get all of these choices because it gives you more control, and the wealthy just have more choices. So why wouldn't you want this? Like Craig said, if you're not drinking this Kool-Aid, what are you doing?
Put that on a shirt right there.
Carson's going to start a new shirt business.
Yeah, bumper sticker or a bumper sticker. It could be a bumper sticker.
Hello, Miss Crumby. I know you. And she's asking, what's the time frame for the medical appointment once the application is submitted? You guys might know this better than me. I'm kind of out of the loop in the last couple months.
I don't believe you don't know the answer.
Yeah.
It is usually within 72 hours. It can be faster. It can be slower. If you're not, if you're a seeker, right? Is it Miss Crumby, right? You said you know her,
yeah.
Right? So if you're a seeker, you're someone that you can reach out to your money mentor or your application specialist, your concierge, so life insurance company, and poke us. Hey, what's up? I haven't got that call. What's the number I can call? If you're that person, I love that person. I want to help that person. I want to talk to that person. Bring me all those people, right? So it'll go faster for you if you're that polite squeaky wheel asking if you haven't heard. If you haven't heard and you feel like you should have heard, just reach out to us. Ask us. We'll help you.
I like that.
Okay. This one's from Matt. Craig, do you have a link I could get? I have some follow-up questions to some that I asked during the wealth webinar. Just wanted to clarify.
Yeah, I can't add to the comments, but you could just put my email in there if you want.
Okay. All right. And somebody, while I'm doing that for you, Matt, somebody want to start reading that one?
So last May, I got started on 3 policies for my girls, 8, 6, and 1. The policies are with Mass Mutual when we were still working with them. It did not get approved until January of this year. My financial status changed from May to January, so I could not do annual premiums and the dump-in. I changed the monthly premiums to start. P.S. This reduced my dump-in slightly on all 3 policies, going from annual to monthly payments. This week I called them and said I wanted to ... continues.
I don't see
nowhere.
a follow-up. Sorry, I thought there was one.
But Carson, you're a really good reader. I was very enthralled.
Sorry, I set you up for failure there.
And you left me on a cliffhanger. You know,
kind of feel like
what happened?
Tim the Tool Man Taylor.
Yeah, Jim, if you
neighbor.
could send the rest of that one, let us know what your
maybe he's still typing.
was.
Maybe it's a long
yeah,
question.
Maybe. Okay, we'll come back to that one. I'll leave it up. Okay, I'll leave that one up starred so I don't forget it. Okay. Ron, is it a good idea to fund a policy with a HELOC? I guess the short answer is it can be. Maybe, maybe not.
It depends.
That's what I do.
It depends. If Mr. Helock was here, he would say, we have to look at the spread. We have to see how
What are your
much
numbers?
is it a fixed, right?
Mhm.
Is it a fixed amount? Is it going around a circle? Or we put it here, we're going here, right? Ron, great question. Is your HELOC fixed? Is it a bubble? Is it a variable? If it's variable or bubble, then I'd say no, it's a really bad idea because you can't figure out what the spread's going to be with a spreadsheet like Carson or Craig could do for you. I just use crowns and stuff. But then, if you know that it's fixed and if it makes sense and you can arbitrage the money or you can move that money, then it can make sense. So it just depends.
Yep.
Okay, and I put Joseph's email in the chat for any HELOC questions. He's the master. So definitely refer to Joseph for that one. There's a lot. Okay, Jim did answer. Okay, here's the rest of it. I feel like Carson should finish this one off since I left him high and dry.
There it is. All right, let me read the last sentence of the last one so we remember what he's saying.
I'll
So he
here.
says, I changed to monthly premium payments to start. P.S. This reduced my dump in slightly on all 3 policies. This week I called them and said I wanted to make the dump in for the policies and change it to annual premium payments. It was no problem, and they told me exactly what amounts to pay in full for all 3 policies. It was very easy.
I guess there's
Awesome.
a question to that. But
Jim, in
happy we
service
read
of
it.
all of us, thank you for sharing that story. So you see, Jim saw an answer, he asked the question, and he went and found it. He's a seeker. Thank you, Jim. That's amazing. And congratulations getting that set up for your kids.
Love it.
7
That's
months
awesome.
is patience. Like we were trying to figure it out today about going like, how long does it take someone to go from start to finish? I'm like, well, sometimes it's 13, 18 days they're getting approved and they're funded in 30. I have people in New Jersey who started in October with me, are still approved, still say they want to move forward and haven't finished yet. So it can take a while at times too. So anywhere between super slow and super fast. Just depends.
Okay, this from Infinite Banking Concept. That's interesting. What circumstances would you do a 50-50 or like you mentioned 60 for base if they don't plan on using much cash value anytime soon?
I think, again, it comes back to our earlier question. What are you trying to solve for?
And I think that's what he's asking.
Yeah.
He's asking, what is the purpose?
Well, one example would be, let's say you're 70 years old and you're trying to do a dump in with a certain premium. If you start to either add more term, that can keep the policy from being a mech. But if you start to lower that ratio where there's more base, that can help you or prevent you from having to add more term. So if I try to do a 60-40 on someone that's 70 years old, I may have to throw some term in there. If I drop it down to a 50-50, I may not have to do term. So that's one design consideration. It's just about the cost and how much money's coming in, what's it doing. But the 50-50 is going to be efficient in the later years, like what you were talking about with the child's policy. And I mean, if you've got a long time to grow, that base is going to help grow that policy more efficiently down the road. So those are a few
Another
examples.
way I look at it too is, because after 10 years, Craig mentioned that all the riders drop off. It's just the base policy after 10 years. So if your base was, we'll say 25%, then 10 years and on, you're only allowed to put that small amount in, and you're not going to get as much when that ratio is, 200% cash on cash return. You don't want to put small amounts in. You want to put everything you can through it. So the bigger base actually allows you to do more later on and get more out of it. So there's also that too.
How long is your runway? Like what Craig was just saying was amazing, right? And that's like Gina, right? Told, he was sharing earlier, she said that he's a genius in these designs and don't use his superpower too often. He just gave you a great example of like the breadth of knowledge, right? Like if you're older, it might take more base to do a dump in or to accomplish the goal. But if you're Carson's age, then maybe you want to set something up where it's, you're doing 50-50 or you're doing even 60% towards the base, because then when you really start seeing that, thinking long-term, that return, then you have a lot more to work with. So it just depends again on the goal. So, and the length of the runway, how long in tooth are you?
Mm-hmm. Good.
Andy says, when transferring the ownership of an IBC policy from you to your child or another person or entity, Is there a tax consequence if loans are taken because incidents of ownership?
We talked about
Somebody
this literally
somebody
today.
asked this question. I've been asking this question all week. So, Andy, one of the things that I did is I went and asked a CPA, and I also asked some other mentors that I've had in this business, and I'm getting conflicting answers. But I don't know. I mean, if you're transferring into a trust, because I know you and I have talked about trust in the past, but if you're transferring into a trust that's irrevocable, there is no taxable consequence there. But I'm not sure. I mean, I've had mixed responses from people, so I don't know if anybody else has any ideas. I know, Jim, you're on. You work in the CPA world. If you have some thoughts on this, but I've not been able to get a firm answer myself.
And we will keep working on it. We'll let you know, Andy, as we find out more, because that's what we do here. As we learn something, we turn around and teach it as soon as we know it and have made sure that it's true. So
Yeah, and then things change and we have to relearn something new.
always,
And
things
Jim
always change.
Yeah, and Jim just answered that it does on person to person. And I think where those limits come in is the taxable gift. So if you exceed that taxable gift, that's the taxable portion. So I think that's my understanding of how it works.
Says, however, based on the equity in the policy being transferred, you can use the gift exemption.
Okay. Yep. So
we'll have to dive in more into that. Definitely. Okay, where was I? I lost my spot. Okay, here I am. Paul says, when I loan money out, is it necessary to hold the loan payments in any sort of special bank account or a business bank account, or is it just for tracking purposes? We get that one a lot.
Yeah, the segregated bank account that we talk a lot about is really for tracking. There's no legal reason that you have to do it. So when you take a loan out, if you want to just be able to kind of track things. So for example, let's say you take a loan out and then you're going to do private lending with the private money club. That segregated account is just that place of record where money's coming in and out of. It just makes it easier to track, but it's not required.
Just keeps it clean. We want to keep it clean for you. That's why, the name says what it is. It's segregated. It's over there. It's just used to fund your policy, used to take loans to your policy, used to pay back the loans to your policy. Just keeping it separate. Because then if you're starting to loan out to other people, where's that money coming back to? Like, just trying to keep it clean for you. But you don't have to do that, right?
Yep.
Okay. Clouds and Taurus says, what are the pros and cons of simplified whole life?
I didn't get that one. I saw that one. I had no idea. You guys? Anyone?
Yeah, you've probably seen those commercials, the Jonathan with the colonial, I think it's colonial pin, $9.99. There's the 3 Ps, price, price, and price. I don't know if you guys seen that commercial.
No, I have no idea what you're talking about. What TV channel are you watching? Is this like on TBS or something?
Oh, there's a stupid show I watch called Wipeout.
Or PBS?
Yeah, it's not PBS. I don't even know what it is. But anyway, this guy shows up on there all the time. But it's basically, I think Simplified Whole Life is really all about kind of those final expense type policies. So if you're, you can buy these really cheap policies that then can provide some death benefit to, wrap up some of the final costs. And even if there is a little bit of cash value growth in there, the way I would look at this is it's no different than walking down the street to State Farm or Prudential. Hey, I want a whole life policy. And the way they'll design those is they'll put all of your money into base and there's no cash value. So I think the simplified whole life would perform the same way, where it's just not going to be a good tool for the infinite banking process.
So it's not specially designed for you. Just to solve that problem of, you're towards the end. Maybe it's harder to get life insurance, but you want to leave something for your kids so they don't have to worry about it, or your family.
Right.
So
has anybody on here heard the Jonathan commercial? I'm just curious now. Am I the only one that's ever seen this commercial with Jonathan with the $9.95? $9.95. You can't be turned down for anything. It's $9.95.
No, I still don't have any idea what you're talking about.
No,
All
me neither.
right. Well,
Maybe somebody in the audience might though. Who
I'm
knows?
just telling you, if is there anybody in the audience who can back me up, I'd love to hear it. But if
Not
not,
like-
go out and Google it. It exists.
Oh,
It's-
Craig, you're a man of integrity. I have
Yeah, we
no
don't think
doubt
you're a
that it
liar.
exists and it's for real. I just have never seen it and don't even know what you're talking about.
I feel bad now that no one. I mean, there's like crickets. So anyway, we'll move on. What's next?
Scott says, "What about us old guys?" He's 64 in doing a $50,000 dump in and the physical required with a whole life policy.
Well, there, Scott, I mean, that was where I would start the question with you is there a concern with the physical, right? Because they will come do your, your height, your weight, your blood, your urine. They're going to make sure that you're as pretty on the inside as you are on the outside. So if that's a concern, I mean, that is something where maybe we're rethinking our thinking and wondering how else is there another insurable interest that you could still have the banking function and process work for you. That's maybe not on your body if that's a concern. So, because you will go through that. And 64 is not old, man. We have others that are older in process. So,
do you think when he asked this question, he was asking, what about the policy split for someone who's older?
I think that might be it too. But then when you asked about the physical, I was thinking that caught my attention.
I don't know. Yeah, clarify, Scott. Maybe we'll answer that question too, if that's your original thought.
People have seen it every other day in Cali, and Facebook user says, "Yes, I've seen it."
I've been vindicated. Thank you.
But
Thank you so
Scott
much.
said no. Or where's Scott? Nope. He said yes to both.
Awesome.
So yes.
So one of the things, Scott, just to keep in mind is the dump-in has to be supported by a ongoing premium. And in order to keep the term under control, the further you get away from that 50K and that premium, so let's say you do a 50K premium a 50K dump-in and a 10K premium, you will need more term if you do a 50K and a 6,000 premium, which you probably couldn't even do anyway. But I'm just saying, the further those two numbers get apart, the more term you have to throw in, the more cost there is. So what I've done in some cases, if we can take some of that 50K and use that as, some premium for year 1, 2, whatever it might be. But those are just some things to think about. Is we need to have a premium that backs up that dump that isn't really far away from that 50K. Otherwise, you're going to be putting a lot of term in the policy.
Think of it this way: the easy, like everything Craig said is true, and then it's easier to think, okay, there has to be enough base to support a dump in to keep it from being a taxable event, right? That's the measurement we're looking for. Like, how do we avoid it becoming a taxable event?
Yeah, so. and the thing is, we can't look at, well, I'm not going to do a policy if it has term in it. A lot of us have term in our policy. I have term in some of my own policies. It's just we try to optimize the cash, and that's one of the things that we would do is remove some of the cost, the drag. But by no stretch of the imagination, term is not going to be a horrible thing if you have in your policy, because most of us probably have it in there anyway. Thanks to the IRS. But anyway, that's just something to consider.
Yeah, term is not always bad. Okay. James says, do you know of anybody using Northwestern Mutual for IBC?
I'm freaking out a little bit right now. I swear someone was on Craig and I's call earlier. We covered all these topics. Almost every question that was talked about on here today was talked about an hour ago.
It's tapped. My phone's been tapped.
Tapped for real. Like, I knew I was going to get rid of Sprint anyhow. They've been kind of messing up stuff. So.
Oh, I can share a real life example. I just had someone reach out today in email that Northwestern Mutual designed a policy for them for infinite banking. And let's just say, as an example, this is pretty close. They put in 15,000. They have about 2,500 to 3,000 in cash. Well, that doesn't happen when we design the policy. So I wouldn't say that's a good design for infinite banking. So are there folks using Northwestern Mutual policies for IBC? I'm sure there are. And I think Hannah might even have some, but they're mature. One of the problems is you have an interest rate, I think, of 8% on Northwestern Mutual right now.
On the loans.
On the loans. So, it's anyway, just some of those things to be considered. But can we get a better tool than what Northwestern Mutual might be able to provide, certainly can.
Can you because let's say that there's somebody who has a policy existing with Northwestern Mutual they thought was designed for IBC. Let's say it's a couple years old and they're like, oh shoot, I don't want this. I want a real IBC policy with you guys. Get rid of this one. What do I do? Like what would your response be to that person?
Well, we can do what's called a 1035. So you can actually transfer that policy over to a new one. But before I even go down that road, I would want to understand how that policy is working. Because there have been some Northwestern Mutual policies that have been mature that came across, that I've talked to other folks with, and like, yeah, let's just keep this. I mean, it's mature, it's efficient at this point. They've had it for 15 years. But if it's new and there's not a lot of cash in there, I would certainly look at options of either transferring or, in some cases, we just say goodbye because there's just not enough cash there to transfer.
Yeah, in most cases, any existing whole life policy, it's not worth changing at that point. Even if it is new, most times there's got to be a really, really good reason for us to do a 1035. But that is an option. People have used it. But most of the time, I mean, worst comes to worst, just have us look at it.
And Drew's mentioning too that his was 10 years old and he 1035'd his. So there could be cases where it makes sense and sometimes it doesn't. But I'm always very cautious about just willy-nilly doing a 1035. I always want to make sure if the policy's not going to do what you want it to do, then we'll move forward with that.
I think that's the first thing. What was the intent of the policy? If it was for death benefit and legacy and it's doing its job, right? Like you didn't know about IBC at that point, then it just depends on how much death benefit that's putting on your body compared to what you're doing now, because you can't overinsure your body. Or like if I run into that where people have multiple terms, multiple this, multiple that, and it was never the intent to get rid of any of those policies. But when they're like, well, I really want to do this IBC policy and I am dumping in a lot of money, and it is putting term for 10 years, right? And so it's over-insuring me. So then they've 1035 policies or gotten rid of policies, surrendered them. So again, it really comes down to what is the problem you're solving? What was the intent of it? What is it doing? Because we're not just going to tell you, hey, 1035 this because we want you to do IBC. We want to know why you're doing it. What's the outcome? What's it really solving in your life, right? So.
Yep. Agreed. Well, guys, we're a few minutes away from time. I don't see any more questions. I guess we will wrap up there. Any final thoughts?
Always have final thoughts. Drew's got I like his little additional, what he just wrote. Like, he said, my big thing was access to cash, having 50,000 just sitting around doing nothing versus being in a PMC deal just felt wasteful. Right. So he's saying like, hey, his thought was, I got some lazy money. My lazy money doesn't need to sleep. I think I should put that money to work. How can I put it to work? How can I have that make me $500, $600, $700 residually a month, right? Or whatever that number is. So, I mean, that's really the question we're teaching people. Again, it's not the product, it's the process of moving your money. And I've been thinking a lot about this, right? Because when you're recapturing and building your wealth through your debts and expenses that exist today, like I was thinking, well, if you can make a bigger spread, wouldn't you do that? And I was thinking, well, maybe not, because your debts and expenses you have right now are what they are. And that's a guaranteed rate of return. If it's credit cards and your accumulative across the board for 5 or 6 cards is like 17 or 18%, that's an 18% return to your money. Like that's how you're growing your wealth. Like you're taking back that interest you're paying to someone else, right? So I've been thinking a lot about that this week, that question. Would you look to see and Craig, I'm asking you, would you look to see what that money's doing before you put it into a deal to make more money when it's an investment that in my mind equals risk, even if it's low risk, versus would you do the guaranteed, get rid of debt and then start looking in the investment tank?
Yeah. I mean, typically it makes a lot of sense to do debt payoff first, because if you're paying 25% to a credit card, are there places we could find 25% investments? There are, but they come with more risk. So wiping out that debt, in my mind, would be step number one.
Yep.
Guaranteed. You got 2 guarantees. You got guaranteed growth in your policy and guaranteed return on your debt.
Yep.
That's my final. I like that. Let's grow some wealth through our existing debts and expenses. People, if you buy cars, why aren't you buying them through your policies? Let's go.
I do like cars.
I do too.
Yeah, we've got an ebook for that. Email me and I'll send it to you. Gabby@chrisnaugle.com. All right, guys. Well, I guess we'll wrap there. Thank you, everybody, for joining us for another Ask Me Anything happy hour. Next week, I think we should have the full crew back, but us four, we're glad to have everybody here today and to answer your questions. And we look.
We're gonna let him back. I don't know. Do we let him back? I think we rocked it today. So,
Yeah.
Carson, are you riding again tomorrow? Are you gonna try a harder trail?
Let's do it. No, I'm down. I told him, I said, hey, I'm going again next time.
That's amazing. That's what we want to see. We should
Happy
be
Wednesday, everyone. Enjoy the rest of your week, and we'll see you next week.
All right. Bye.